Imagine you're logging into a Bloomberg terminal on Wall Street. You scroll past the spot price of gold, past barrels of Texas crude oil, past like Brazilian coffee beans.
Right.
And right there, sitting shoulder to shoulder with the most established traditional commodities on Earth, is the exact Nvidia computer chip that's powering your favorite AI chatbot.
It's quite an image, isn't it?
It really is. And, well, welcome to this deep dive. Our mission today is to tear apart this really fascinating stack of notes on a massive paradigm shift that's happening, entirely behind the scenes. We're looking at the financialization of compute. Basically, how computer chips, specifically graphics processing units or GPUs, are transforming from physical pieces of tech hardware into a major, globally traded, highly regulated financial asset class.
Yeah, and the catalyst for everything we're about to discuss today is actually sitting right there on that Bloomberg screen you mentioned.
Oh, right. The index.
Exactly. It's called the ORM Compute Price Index, or the OCPI. Because up until now, if you wanted to track the value of computing power, you were kind of forced to look at these disparate hardware markets, right?
Like secondary markets and stuff?
Yeah, fragmented secondary markets or, opaque cloud rental agreements. It was a mess. But the OCPI takes all of that and aggregates it into a single standardized picker.
Wow.
It basically takes this incredibly complex, fast-moving technological ecosystem and distills it into a pure financial metric.
Okay, let's unpack this because I'm still trying to wrap my head around the cognitive dissonance of that visual.
It is a lot to take in.
Right, because we're all conditioned to think of GPUs as like the glowing hardware inside a gaming PC. Or, physical racks in a server farm out in the desert somewhere.
Yeah, physical objects.
Exactly. And treating processing power like a bushel of wheat, that fundamentally changes the relationship society has with technology.
It totally shifts the paradigm.
But, if this is going to be a true financial asset, it obviously can't just live on some niche, unregulated crypto message board.
Oh, absolutely not.
Because Wall Street institutions are not going to trust a random startup to handle billions of dollars in trades. So who actually has the muscle to, legitimize this and make it a real market?
Well, that's the pivotal detail in our source material, because ORN, they aren't actually trying to build their own exchange from scratch.
Oh, they aren't?
No, they're launching exchange-listed futures on GPU compute through the Intercontinental Exchange.
Wait, the Intercontinental Exchange? Like ICE?
That's the one.
But that's the parent company of the New York Stock Exchange.
Exactly. It is the absolute top of the traditional financial food chain. ICE provides the established plumbing, right?
Right.
The deeply entrenched regulatory frameworks, and perhaps most importantly, the trust of the world's largest financial institutions.
Because everyone already uses them.
Exactly. When you bring an entirely new asset class to a platform of that magnitude, you basically bypass the whole Wild West phase of market development.
Oh, wow. So it's instantly legitimate.
Precisely. GPU compute instantly becomes this formalized financial instrument with massive institutional reach.
Okay, let's pull the camera back and look at the mechanics of this. Because I'm picturing those old stories of traditional commodity futures,
Oh, I know where you're going with this.
Right. Like occasionally a novice trader forgets to close out a position on agricultural futures, and suddenly they have like a train car full of live cattle delivered to their driveway.
Or a mountain of corn, yeah.
Yeah. So wait, if I buy a GPU future on ICE and I hold it to expiration, am I going to need a forklift for a pallet of microchips?
You can leave the forklift in the garage.
Okay, thank God.
Yeah. Pending regulatory approval, of course, these are structured as U.S. dollar-denominated cash-settled contracts.
Okay, cash settled, meaning the actual physical hardware never changes hands between the traders on the exchange.
Exactly. The mechanism is entirely financial. Instead of forcing traders to figure out how to transport or, store, power, and cool a warehouse full of highly delicate tech hardware.
Which sounds like a nightmare.
It would be a complete nightmare. So instead, the contract settlement simply references the ORM Compute Price Index.
Okay, so how does the math actually work on that?
Well, if you buy a futures contract and the index price of compute goes up by, say, 10%, the counterparty just pays you that difference in U.S. dollars.
Oh, I see.
Yeah, it creates a highly liquid paper market where participants can trade strictly on the price movement of the underlying compute power. No physical delivery required.
Well, it definitely solved the logistical nightmare of moving silicon around, but it still leaves a pretty glaring vulnerability, I think.
What's that?
Well, compute is an impossible broad term, right? Like the laptop I'm using right now to read these notes has compute.
Sure. Technically.
But I highly doubt hedge funds are rushing to IC to trade futures on a 3-year-old consumer laptop.
No, they absolutely are not. And the market structure actually reflects that reality.
How so?
Well, the underlying assets for these futures contracts are incredibly precise. The source material outlines that the contracts will cover multiple, highly specific GPU
Oh,
architectures.
so it's not just a generic bucket.
Not at all. We are looking at specifically the Nvidia H100, the H200, the B200, and the RTX 5090.
Wow. Okay, so that is a very deliberate roll call of the most powerful, highly sought-after chips on the planet right now.
Exactly. The market actually demands that level of precision because, tech depreciation is uniquely violent.
Uniquely violent. I like that phrase. What do you mean by that?
Well, think about how value decays in other commodities. A barrel of oil from 10 years ago is still a barrel of oil today, right?
Graphite burns exactly the same.
Exactly. But a computer chip from 3 years ago, it might be functionally useless for training a modern bleeding-edge AI model today.
Oh, totally. It's basically a paperweight compared to the new stuff.
Right. So the value of older generation hardware behaves entirely differently than the newest NVIDIA architecture. If you lumped it all into a generic compute bucket, the index would be completely useless for hedging risk.
Here's where it gets really interesting to me, because it's just like agriculture.
How so?
Well, if you're a massive bakery operation, you don't call your commodities broker and order, like, grain.
Right. That means nothing.
Yeah, you order a highly specific grade of hard red winter wheat, because that's the exact specification your supply chain requires to function.
That's a great analogy.
And so the financial world is standardizing these specific NVIDIA chips into distinct tradable grades and treating them with the exact same rigor as agricultural or energy commodities.
Yeah, standardizing a physical commodity into distinct grades like that is really the foundational step required to create a mature market.
Mm.
And looking at how this standardization is happening for compute, the financial historians in our source material are actually pointing to a massive market transition we've seen before.
Really? When was that?
Dr. Wisner-Gross draws a direct parallel to the year 2000.
Oh, wow. So we have seen this exact movie before, just it wasn't playing in Silicon Valley, it was playing in the energy markets.
Exactly. Because prior to the year 2000, the global energy market, specifically oil and gas, were incredibly opaque.
Like hard to see pricing?
Yeah, they were traded primarily over the counter, or OTC. And in an OTC market, there is no centralized screen showing you what everyone else is paying.
So it's all just hidden?
Pretty much. It relies entirely on bilateral agreements.
So you're basically calling someone on the phone, negotiating a price, and just, like, hoping they don't go bankrupt before they actually deliver the oil.
Pretty much. You are taking on massive counterparty risk. It was highly inefficient.
Wow.
So what IC did in 2000 was they stepped into the middle of that chaos. They moved those opaque bilateral energy markets into transparent electronic clearing.
Right, the clearinghouse model.
Yeah. The clearinghouse basically sits between the buyer and the seller, guaranteeing the trade and completely removing that counterparty risk.
And that transparency is what ultimately allowed the market to agree on a single global standard, right? I mean, that was the birth of Brent crude as the undisputed benchmark for global oil pricing.
If we connect this to the bigger picture, Dr. Wisner-Gross argues that the ORM Compute Price Index, combined with ICE's clearing infrastructure, is executing that exact same playbook for GPU compute today.
You know, people love to throw around that cliche that data is the new oil.
Oh, all time.
Usually it's just a metaphor, to describe how important tech companies are to the modern economy. But this takes it from a metaphor to a literal financial pipeline.
It really does.
Compute is undergoing the exact same financial life cycle that energy went through to become a globally traded standard. We're literally watching the real-time creation of the Brent crude of compute.
Establishing that undisputed benchmark is really the key that unlocks the door for institutional capital. And honestly, the scale of the capital waiting at that door is staggering.
Yeah, the numbers in the notes are wild.
Right. Our sources detail a projected $7 trillion compute build-out over the coming years.
$7 trillion.
Yeah.
I mean, that is not money being spent by a few tech enthusiasts in a garage. That requires the absolute heaviest hitters in global finance.
Without a doubt.
So let's break down the mechanics of how this $7 trillion ecosystem actually uses these ICE futures. Because our notes outline 4 very distinct players here.
Yes, they do.
So let's start with the first group stepping up to the plate. Lenders.
Okay, so lenders are the ones providing the initial massive capital injections to actually build these data centers.
Right.
But financing GPU infrastructure carries a unique, terrifying risk.
Which is?
Well, you might lend $2 billion to build a state-of-the-art server farm today, but if the price of compute crashes 6 months from now, the revenue generated by that data center won't cover the debt service.
Oh, man, so the loan just defaults.
Exactly. The loan defaults. But once these futures clear at ICA, lenders can directly hedge that financial exposure.
Okay, so how do they do that, practically speaking?
They can take positions in the futures market that actually gain value if the price of compute falls, which perfectly offsets the potential losses on their underlying infrastructure loans.
That's brilliant. It effectively neutralizes the volatility of the asset, which I assume makes the lenders willing to open the tap and pour way more money into the sector.
Exactly. It removes the fear.
But lending only covers the initial purchase of the hardware. The real nightmare in technology isn't buying the asset, it's the fact that the asset inevitably becomes obsolete,
So true.
which brings in a totally different financial player to catch the falling knife, right? The insurers.
Yeah, insurers. Insurers face what is called residual value risk.
Residual value risk. Okay, break that down for me.
Imagine an insurance conglomerate underwriting a massive server farm. They have to project what those thousands of GPUs will actually be worth in 3 or 4 years when the lease is up or the hardware is rotated out.
Which in the tech sector feels nearly impossible to predict.
It is. Nvidia could announce a breakthrough new architecture tomorrow morning, and by tomorrow afternoon, the residual value of that insured server farm has dropped by 40%.
Wow. So before these futures existed, an insurer just had to absorb that shock or
Yeah.
charge exorbitant premiums just to cover the unknown
Exactly. But with the liquid futures market, insurers can actively manage that residual value risk.
because they can hedge it, just
Yeah.
like the lenders.
Right. If they are exposed to the physical depreciation of older chips, they can use the futures market to construct a hedge. The financial plumbing allows them to transfer the risk of technological obsolescence to other market participants.
Participants who are, willing to take the other side of that trade.
Precisely.
Okay, so we have lenders protecting the initial capital, and we have insurers protecting the depreciation. But they're really just surrounding the asset. We have to look at the people actually operating the hardware, the hyperscalers.
Right, the hyperscale.
These are the colossal cloud computing providers, the tech giants who are actually running the massive AI models.
Yeah, and the hyperscalers are driven by operational strategy. They have to guarantee they have enough processing power to meet this skyrocketing future demand.
But they also need predictability on their balance sheets, right?
Exactly. And the ICE futures market allows hyperscalers to lock in their forward compute costs today for capacity they won't actually use until next year.
Okay, let's elevate that strategy for a second because it's not just about keeping the accounting department happy. It is about cutthroat competitive pricing.
Oh, absolutely.
Think about commercial airlines. An airline knows they have to fly thousands of routes next year. They don't just wait and hope the price of jet fuel is cheap on the day of the flight, right?
No, that would be disastrous.
Right. They buy jet fuel futures today to lock in the price. And if one airline successfully hedges their fuel costs lower than their competitor, they can offer cheaper tickets and just steal market share. So what does this all mean? It means cloud computing giants can lock in their future tech costs exactly the way commercial airlines hedge the price of jet fuel. Hyperscalers are about to do the exact same thing with processing power.
That's spot on. If a cloud provider can lock in their future compute costs at a favorable rate using these futures, they can systematically underbid rival tech giants on AI services and cloud hosting.
Wow.
It turns financial risk management into a direct weapon for market dominance.
But I mean, operating on that scale and building out $7 trillion worth of infrastructure, that requires a pool of capital that dwarfs even the biggest tech companies.
Oh, easily.
Which brings us to the fourth, and arguably most consequential, group mentioned in the notes.
Yeah.
Sovereign wealth funds and pension funds.
Yeah, sovereign and pension funds represent the deepest pools of capital on the planet. I mean, they are managing national wealth and global retirement accounts.
Right, so by statutory definition, they have to be fiercely conservative.
Exactly. They operate under strict fiduciary mandates regarding risk, historically dumping billions of dollars into a highly volatile, completely unregulated secondary market for tech hardware.
Would be a massive red flag.
It would be a clear violation of their fiduciary duty. The risk of the unknown was simply too high.
At the same time, though, if you're managing a national pension fund, You can't exactly look your retirees in the eye and say you completely missed out on the returns of a $7 trillion technological revolution just because it was, too messy.
Right. They are trapped. They're trapped between the mandate to protect capital and the mandate to generate returns.
So how does this fix that?
Well, the transition of compute onto ICE via the ORM Index builds the bridge they need. Sovereign and pension funds can now safely participate in this massive compute build-out through a regulated risk management infrastructure.
Because they don't have to buy physical chips anymore.
Exactly. And they don't have to trust unregulated bilateral agreements. They can deploy capital into a transparent, centrally cleared market that is overseen by the exact same regulatory bodies that govern traditional equities and commodities.
So they finally have a sanitized, institutional-grade on-ramp to the AI boom.
Yes, they do.
Looking at the sheer scale of this, from Wall Street lenders all the way to global pension funds, it raises a glaring question for me about the timeline here.
What do you mean?
Well, we're talking about this as if it's a fully matured financial ecosystem. But it feels like, just 3 years ago, GPUs were primarily discussed in the context of video game graphics.
Right, the speed is wild.
How did this evolution happen so incredibly fast?
The timeline is arguably the most fascinating data point in this entire analysis.
Yeah.
Because the historical contrast is stark.
In what way?
Well, traditional commodities, like the oil and gas markets we discussed earlier, they took the better part of a century to develop mature futures markets.
Wow, a century.
Yeah, it was a brutal, slow crawl. From physical barrel trading to opaque phone calls to eventually reaching electronic clearing in the year 2000.
Just 100 years of painful trial and error, market crashes, and regulatory battles just to figure out how to properly trade energy.
Exactly. But compute has gone from a niche physical product to a centrally cleared, cash-settled financial instrument in a fraction of that time.
So why did it happen so fast? I mean, what was the shortcut?
Compute achieved that maturity in a matter of years for one brilliantly pragmatic reason. They didn't try to invent a new system.
So,
The tech industry, which is usually so obsessed with disrupting and rebuilding absolutely everything from scratch.
right, move fast and break things.
Exactly. But here, they simply utilized the exact existing clearing plumbing that the energy market spent a century building.
That's hilarious. So the tech industry basically just copy-pasted Wall Street's century of energy market homework.
That's literally what they did. The architecture of the Intercontinental Exchange, the legal framework of a cash-settled future, the mathematical structure of a price index, all of it was already perfectly optimized to handle a high-demand, globally critical commodity.
So there was absolutely zero need to reinvent the wheel.
None. They simply swapped out barrels of Brent crude for Nvidia H100s, plugged it into the ICE clearinghouse, and turned the machine on.
Man, it is a stunning display of efficiency because we're so used to the narrative of Silicon Valley, like declaring war on traditional finance, right?
Yeah.
Trying to replace it with decentralized apps or novel crypto structures.
Right.
But here, the smartest minds in tech realized that when you need to move $7 trillion safely, you don't fight Wall Street, you just rent their pipes.
And that reality is vital for you, the listener, to absorb. Because when a technology like artificial intelligence scales at this unprecedented speed, understanding the financial plumbing behind it becomes just as critical as understanding the neural networks themselves. You cannot accurately predict the future of the cloud computing industry without understanding how the massive capital required to build it is being hedged, protected, and deployed. The financialization is the quiet engine actually driving the innovation.
Okay, let's distill exactly what we've uncovered in this stack of notes today. We started by looking at this visual anomaly, the ORM Compute Price Index sitting on a Bloomberg terminal.
Right.
And we traced how that index is being used by ICE to create U.S. dollar-denominated cash-settled futures contracts. Contracts that are specifically pegged to high-end Nvidia architectures to account for rapid tech depreciation.
And we saw how this perfectly mirrors the year 2000, when ICE brought transparency to opaque energy markets, effectively creating the Brent crude benchmark for compute.
Which laid the groundwork for a $7 trillion ecosystem. Lenders can now hedge their debt exposure. Insurers can offload the residual value risk of aging server farms. Hyperscalers can lock in their forward processing costs to wage price wars against their competitors. And massive conservative pension funds finally have the regulated safety they require to deploy their trillions into the tech sector.
It's all connected.
And All of this was accelerated by decades because compute simply adopted the financial infrastructure that energy markets spent a century perfecting.
It is a profound synthesis of raw technological power and sophisticated financial engineering. And honestly, it leaves you with a final thought to mull over long after this deep dive ends.
What's that?
Well, now that processing power can be locked in, traded, and hedged with the exact same financial instruments used by commercial airlines for jet fuel, how does that shift the culture of the tech giants?
Oh, that's interesting.
Will the defining tech companies of the next decade prioritize the financial engineering of their compute costs just as heavily as they prioritize their actual software breakthroughs?
Wow. It certainly makes you wonder if the ultimate competitive advantage in the future of AI will come from a brilliant software coder or, from a ruthless futures trader sitting at a terminal. Keep questioning the layers beneath the surface and always look for those surprising connections between the technology shaping your life and the financial plumbing making it all possible. Thank you for joining us on this deep dive.